Uh, Good evening to all the viewer of this particular webinar, which is organized on virtual mode. And we have kept the topic for this today's webinar is joint development agreement, the real sector GST impact on the joint development agreement. We have with us CA Arun Kumar Agarwal from Calcutta and CA Subham Khetan he is also from Calcutta, both the learned speaker and have a thorough knowledge of the subject. I'm thankful to both of them for joining. We also have CA Rajendra Kumar P, Vice Chairman to GST and Indirect Tax Committee. I welcome you, sir, also. And viewers, this regular webinar GST and Indirect Tax Committee is organizing for the benefit of our members. For the benefit of our member, so they can, sitting at home, have their queries resolved, because this webinar also have a facility allow you all our viewers to raise their queries. The link has been given to you and you can type your queries. After presentation of the speaker, we will handle all the queries. In the meantime, GST committee, as usual, always try to serve best possible manner. And if anything, any of our member wish that in the GST and Indirect Tax Committee of ICI should do in this particular area of GST or any other field of indirect tax, they may write in the chat box also, not the chat box basically, question answer box only. Our GST and Indirect Tax Committee is watching this and definitely we will try to do the same. And this webinar will be a weekly webinars, and every week we will have this webinar. So please keep on watching the website of the GST and Indirect Tax Committee for regular updates. Over to, before I ask the speaker to present their topic, I'm requesting C. Rajendra Kumar P. for his initial remark, who is also expert of GST, served the GST and Indirect Tax Committee for consecutive 3 years as chairman. Now, as a guiding factor, he is working as a vice chairman to my committee, this committee. Thank you, Rajendra ji, for joining. Over to you, sir.
Thank you, my esteemed mentor and chairman of the GST and Indirect Taxes Committee of ICAI, Sushil Bhai. Very esteemed CA Arun Agarwal ji from Kolkata, CA Shubham Khetan ji from Kolkata. The other staff of the GST and Indirect Taxes Committee, Ajay, Dheeraj, and technical support being given by Jay. Esteemed friends, it is my proud privilege to be here before you all. And as my chairman has premised, we are going to hear the views on joint development agreements from two experts. C. Arun Agarwal ji, who hails from the city of Joy, is a very intense practitioner in GST, let me tell you. A person with a deep research and a person who is, I can say, wedded to the process of indirect taxation. Always a busy person, he has taken his time off today to come to our forum today. Thank you very much, sir, for I know your work and I know I do understand and appreciate that you are here in spite of your tight schedule. We also have here Shubham Khetan, the young duck, I must say. So we have the balance of a senior and a person who is just not about more than a decade in practice. Of course, his firm does. Shubham has been a regular contributor like Karunji. Shubham has been always a person who has cooperated, who has. I have always found him to be a person who says, never say no man. He's always a positive person with a positive outlook. And today, both of them have a tough task to cut out. The joint development agreements in the GST scenario or indirect taxes, you may say. But I come from the state of Tamil Nadu, and it is here that the first time the taxation of works contracts was born. When the country knew only taxing goods, pure goods, works contract became the subject matter of taxation for the first time. And then, of course, Supreme Court, the matter went up in Gannon Dunkerley, and then the Constitution Amendment was actually triggered by the Tamil Nadu's amendment in levying sales tax on works contract for the first time ever in this country. But time immemorial, contracts, construction, land, and every part of immovable property relating to the properties debate. Esteemed friends, we are going to have a treat today. We are going to listen here, but let me tell you, caution you that every place, at every city, every state, you will find different forms of varying forms of joint venture agreements, joint development agreements. So you must not look at queries and questions only to specifically to your city or your state. There may be new areas which you can look into, because as I have always told, I was talking to Shubham a few while ago, that the way the agreements are entered will decide the taxability. That's how it is. And let's hear both of them, intense practitioners, and who are going to give us a treat today on this subject. Over to you, Sushil Bhai, for further proceedings.
Thank you, Rajendra Bhai, as always, lucid and effective communicator. Always we hear you with pleasure, and it is always music to our ears. The words you use and the experience you have. I think this joint development agreement, if you try to understand it, this topic is very simple. That there is a developer and there is a landowner. Only two persons, and what is the transactions? The landowner has given right to developer to construct a building or complex, and in turn, the developer will give him few flats, few units, or few commercial space, or rather, in some of the transactions, he give the money in kind, not in kind. He will give the cash transactions, that is the consideration. But the GST department, the GST law says these two persons are also providing services to each other, and these transactions to be taxed. Builder is giving the services to the landowner in the form of giving the constructed units, if he is so giving so. So this is a service and to be taxed. Similarly, the landowner giving right to construct, right to enter plot of land and construct there. So this giving right is also a taxable service. There are disputes about the time of supply, when the tax to be taxed, to be paid by the builder, tax to be paid by the landowner. There are valuation issue on what value tax to be paid, and there are small other issues are also there. Government has keeping in mind the difficulties faced by the this real estate sector. They have given some sort of exemptions also. Tax rate definitely a issue. Friends, in plain and simple language, we always say residential buildings are taxable at the rate of 5%. But let me tell you, tax rate is 7.5%, value is 2/3. So these type of things definitely both the speakers will going to touch upon, and we are pretty sure that after today's presentation, nothing, no doubt will be left in your mind. Definitely, both the speaker will try to clear your doubts. If anything coming to your mind, do write to chat box, and we will try to take up those queries during the at the end of the session. So thank you for joining once again, and I think Subham is starting first. So Subham, first you will give overviews about the topic, and then the issues coming to your mind. What are the issues you think that the people are having? Or in the meantime, I'm requesting viewers, they may raise queries as and when they want. So over to Subham Kata.
Thank you so much to the chairman Sushil Kumar Goyal sir, to the vice chairman Rajendra Kumar B sir, uh, everyone here at the Secretariat who have been instrumental in having me here today. I'm really thankful to the committee for making sure that I have been invited once again this year for presenting on a topic of issues under JDA. So the way we have thought about this topic is that I would be giving a brief background of the topic for some time in terms of the provisions, the time of supply, valuations, what is the taxability. Thereafter, Arun sir would be taking up some issues, and thereafter the few issues would be taken up by me as well after the session. So let me straight away dive into my topic and share my screen here. Is my screen visible properly? Okay. Okay, so first and foremost aspect that we want to discuss, with Sushil sir had also highlighted, is that GST is applicable on construction services provided by any person, provided by a developer or by a landowner for sale to a buyer, except where the entire consideration is received after completion certificate or first occupation, whichever is earlier. So if the entire consideration is received after an earlier of these two dates, it would be considered as sale of land or sale of building, as the case may be, for which there would not be any applicability of GST. Now, when we talk about the competent authority issuing the certificate, who is considered as a competent authority, has been provided here that either the government or the authority required to issue the CC would be considered as the completion as the competent authority, which may include the local authority as well, which is issuing the relevant completion certificate. In case there is no requirement of such certificate from the local bodies, let's say the local bodies don't have the system. For instance, in Darjeeling here in West Bengal, usually we don't see local authorities issuing such certificates. In that case, the certificates issued by architect, chartered engineer, licensed surveyor would also be considered here. So just a brief background with regard to the rates of GST. So we are talking about all projects which have started after 1st April 19. If those are RREP projects, so by RREP projects, we mean to say that those projects where the area of carpet area is not more than 15% of the commercial carpet area is not more than 15% of the aggregate carpet area in the project. So wherever the carpet area of commercial projects or commercial apartments rather is more than 15%, it would not be considered as RREP, that is residential real estate project. It would be categorized as a REP project, which is a real estate project. In case of RREP project, we need to find out whether the apartments which are sold under the residential category, is it an affordable apartment or is it non-affordable apartments? So when we talk about affordable residential apartments, the definition which is given as per law is that the aggregate amount of consideration received for those apartments, if it is less than 45 lakhs and the carpet area is less than 60 square meter in case of metropolitan cities and 90 square meter in case of other than metropolitan cities, in that case it would be considered as an affordable residential apartment. In such cases the rate of GST would be 1.5%, and under GST we would be getting a one third deduction for land, because land is not per se taxable under GST, so it would be effectively 1%. In case of other than affordable residential apartments, effective rate would be 5%. In case of commercial apartments in RREP projects, it also would be 5%. In case of a real estate project, which is other than RREP, that means where commercial area is more than 15% of the aggregate carpet area, affordable and non-affordable residential apartments would have the same rate of GST, that is effectively 1% or 5% as the case may be. Whereas in case of commercial apartments, the rate of GST would be 18% with two-third deduction. Effectively, it comes to 12%. Also, we need to remember, if we are paying an output of 1% or 5% in case of residential apartments, ITC cannot be availed. The entire amount has to be paid by cash. So I cannot pay any amount through ITC if I am having any output tax of 1% or 5%. I have reported my unavailed ITC or ITC which is not to be availed because my ITC is ineligible as part of my ineligible ITC. So ideally, as per a part of my 2B, I should be taking that ITC in my return. Thereafter, I should be reversing it as part of my permanent reversals because I cannot take that ITC. I need to make sure that I'm reporting that my return cannot be having a zero value simply because I'm not availing any ITC. Also, any projects which is after 1419, all the RCM with regard to the rights on the development, that is the development rights, would be payable under RCM by the developer. Further, if I am not availing services from registered persons, so I am having a residential apartment which is getting constructed, I need to make sure I am buying only from registered parties. If more than 80% of my input and input services are bought from registered persons, then only I am in compliance of law. Otherwise, in case of less services, I would have to pay the shortfall under RCM. Also, capital goods has to be entirely paid under RCM if it is bought from unregistered persons. Similarly, cement bought from unregistered persons would also have to be paid under RCM. This default has to be made good by 30th June of the next financial year. When we talk about area sharing agreement, I'll just explain this sort of agreement to you as to what happens in this sort of agreement and what is normally the taxability which occurs here. So in case of an area sharing agreement, let's say a particular project has 100 units. It is divided between the developer and the landowner in the agreed ratio, where some units are taken up by the landowner and the other units are taken up by the developer. For instance, in this case, developer is retaining 60 out of 100 units and 40 units are passed on to the landowner. So the 60 units which are constructed by the developer, we are assuming 40 units out of that is being sold before CC. If 40 units are sold before CC, in that case, the developer is required to pay 1% or 5% without availing ITC. So developer is required to ensure that he is paying this amount without availing ITC in case of RREP project. Since I cannot avail ITC in RREP, I have to pay this amount through my electronic cash ledger. And 40 units apartments which have been sold before CC would be paid through this mechanism. Now, second part, on the 40 units which the developer is transferring to the landowner, developer would be providing construction services to the landowner on value of similar apartments. So developer would be charging the landowner for the 40 units, and for those 40 units, whatever is the carpet area, he would determine that. And for understanding what would be the per square feet rate that he should be taking, he should take similar apartments value, which is transferred to the landowner at the time when the development agreement was happening. So we can assume almost the first flat value which has been sold after transfer of development rights to the landowner. So whatever construction services are provided, developer would be charging based on the per square feet rate of that flat. And obviously the similar carpet area would be taken for the flats which are for those 40 units which are transferred to the landowner. And the rate of GST applicable would be 1% or 5% as the case may be. However, the time at which the developer would be charging the landowner for the construction services would be at the time of CC. So developer can charge the landowner any time up to CC. So it is not like the developer has to charge only on CC, but he can transfer it anytime up to CC. Obviously, there is a bit of planning involved because the landowner, in order to ensure that he can avail ITC and utilize that ITC, he may request the developer to make sure that the developer raises a bill on a continuous basis to the landowner so that the landowner can avail the ITC. And while transferring the 30 units which the landowner is transferring before CC, so the left hand side we can see that landowner is transferring 30 units before CC. This amount, whatever is charged by the landowner from external buyers, landowner can avail ITC on the 40 units which the developer had charged him for, and he can use that ITC for making payment of output taxes on the 30 units that he's selling before CC. On the 10 units which the landowner is retaining after CC, he should be reversing that ITC on the unsold carpet area. So whatever carpet area is unsold for the 10 units, the landowner should be reversing ITC on that. Now, as regards the landowner giving development rights to the developer. So developer is giving construction services and landowner is giving development rights. Developer is required to pay under RCM, but he would be paying under RCM only for those flats which are unsold. In case of RREP, he would not be transferring, a developer would not be paying taxes on sold flats, but only on the 20 units which the developer has not sold. So he would be transferring this, he would be paying GST at any time before CC or at the time of CC. And the value which would be taken by the developer for the purpose of selling this flat or paying under RCM on the development rights for these 20 units which are sold after CC, the developer would be taking the value of first flat or the first flat which was sold during the time of transfer of development rights on 12%, effectively 12% after taking 1/3 deduction. 12% he would be paying on that after taking 1/3 deduction, or 5% on the last flat. So assuming there is no affordable residential apartment, we're talking about 5% on the last flat, which is sold immediately before CC or nearest to the rate of CC. Lower of these two values the developer would be taking and thereafter paying the GST on that. Now I am assuming a revenue sharing agreement in case of RREP. Here the computation would be slightly simpler. 100 units the developer is having which he'll be only selling. 40% of those 100 units which the developer would be selling, he would be transferring 40% back to the landowner. So developer, while selling those 70 units before CC, he would be paying 1% or 5% GST as the case may be in case of residential apartments. Whichever 30 units are unsold, those remain the value of development rights. So again, the value of first flat 18% into 2/3 deduction into the value of first flat sold after the at the time of agreement, development agreement, or 5% on last flat, that is at the time of CC, whichever is lower. Now, area sharing agreement in case of commercial projects. In such cases, what would happen? Here we need to remember the GST would be at the rate of 12%, right? So GST would be at the rate of 12% in case of commercial apartments. That means 18% is the rate, 1/3 would be the land deduction, effective rate would be 12%. So whichever 12 or 40 units the developer is now selling before CC. In the same example, instead of RREP, we have taken commercial project, which is REP. So in that case, developer would be paying 12% GST and he would be availing the ITC for that. And whichever units are remaining unsold, so developer, whatever ITC is availed, 20 units which remain unsold for the developer, he would be reversing the ITC on that. So proportionate ITC. Here, developer would have to find out the ITC in respect of those flats which are unsold based on the carpet area. So proportionate carpet area he would be finding for the unsold apartments vis-a-vis the total carpet area of the entire project, and he would be reversing the ITC on the aggregate ITC availed by the developer. Right? All right. For the developer providing construction services to the landowner, he would be charging GST at the rate of 18% into 2/3 into value of similar apartments once again, which is nearest to the transfer of development right. That means the first flat sold for those 40 units which are sold at the beginning of the project. Now, whatever flats are sold by the landowner from those 40 units, 30 units he would be selling, let's say, he would be availing ITC on those 40 units and then paying GST at the rate of 12%. On the flats which remain unsold at the time of CC, developer, landowner would be reversing ITC on that. So landowner, whatever flats are remaining unsold, out of those 30 flats, 40 flats, he would be reversing proportionate ITC based on the carpet area. So both developer and landowner, based on the proportionate ITC availed by them, they would be reversing the ITC for the unsold area. And as regards the transfer of development rights, both landowner and developer are providing services to each other. Developer would be charging landowner based on the 40 units for similar apartments for 12 at the rate of 12%, and developer would at the same time be paying RCM on the exact same value for those 40 units. So here the developer would be paying GST at the rate of 12% once again, that is taking 1/3 deduction he would be taking, and thereafter paying GST at the rate of first flat sold for those 40 apartments based on the per square feet carpet area of the first apartment. So developer would be paying under RCM for development rights, taking ITC on that, and thereafter charging to the landowner for the construction services. Now, if I talk about revenue sharing agreement for commercial apartments after 1419, so developer would be selling 70 units before CC. On those 70 units, he would be charging GST at the rate of 12%. For the unsold area, that means the 30 units which are unsold, developer would be reversing proportionate ITC on the unsold carpet area. However, in case of revenue sharing commercial apartment, there is a slight bit of difference when it comes to taxability of development rights. Here, the development rights would be taxable at the rate of 18% in the hands of developer on the share of revenue. So whatever revenue is shared, on that revenue, developer would be paying RCM. And he would be taking the actual consideration which has been received here. And here, the taxability would not arise at the time of CC, but in my view, it would keep on arising as and when the developer is paying to the landowner. Obviously, there is one bit of an issue here that there is a view which is there that development rights is transferred on the first day itself in case of revenue sharing commercial agreement. So it would be payable on the first day. So we'll be discussing that in the issues segment. So for the time being, it seems that since the valuation is not crystallized and the time of supply is provides that the taxability for development rights should happen as and when the flats are given, as and when the revenue is given to the landowner from the developer, it would be taxable as and when the monetary consideration is transferred by the developer to the landowner. The valuation would be, of course, the monetary consideration paid. And of course, here in case of revenue sharing agreement, once again, revenue sharing agreement with regard to residential apartments might be slightly different from that of commercial apartments. So we need to be very careful about this distinction, right? So with this, I would like to wind up my side of the segment with regard to discussion on the basic aspects of the joint development agreement to set the ball rolling for everyone. So I would now request Arun sir to take up the first part of the issues with regard to JDA, and I'll come back again to take the second part of the issues with regard to JDA. Sushil sir, would you like to say anything before we transfer to Arun sir?
No, it is fair enough. Let the Arun take up the topic. We are receiving good number of queries. Almost 1,600 viewers are online right now. And I'm just keeping watch on the queries, and we will definitely take after the issues which are in hand. Let it be discussed. Then I think most of the queries will be resolved. If something is left out after that, I will definitely ask both of you, and we will give the answer to the queries. So over to Arun Agarwal now.
Done, sir.
Shubham, you can exit from your screen so that I can share my screen.
Sure. I'll do that. Sir. Yeah, done, sir.
अच्छा, पहले खोल लीजिए। अब हो गया। Yeah. Good afternoon, friends. Am I audible? Sushil?
Yes, fine.
Yeah, thank you. Good afternoon, friends.
Audible, sir. Audible.
Good afternoon, friends. At the outset, I'm thankful to Indirect Taxes Committee, GST, and Indirect Taxes Committee for giving me this opportunity to share some thoughts on some of the issues specifically allocated to me on the topic GST related to the topic GST on Joint Development Agreement. In fact, Shubham has absolutely, in a brilliant manner, he has set the discussion rolling. He has opened the issues, the subject. But in fact, I was hearing Sushilji, chairman of GST committee, who was very smartly saying that it is actually as simple as that, that it is a construction by a builder and sale of flats to the customers or flats or units as the case may be, whether it is residential or it is commercial. And instead of buying a land, the builder is actually taking land from landowners who does not have the resources to deploy and does not have the expertise to do marketing, sales, and do the project management, etc. So they are only contributing their land, and builder is taking their land and undertaking construction of the project and the entire gamut of all the responsibilities, starting from conceivement of the project to completion and sale of the project to customers, realization and sharing of the revenue up to that time. So Sushil very nicely said that actually it is a very simple transaction, but this simple transaction has various complications, various issues arising out of it. Why it is so? Friends, it is because in case of a real estate project, there are three elements, there are three components. Number one is land, number two is material, and number three is services, that is the construction service being provided by the builder. So, land, material, and services. Earlier, in fact, prior to even service tax also, prior to 2010, or maybe let us go back to prior to 2004, there was no tax liability on the real estate. There was no tax liability because it is plain and simple. It is a sale of immovable property, and sale of immovable property would neither attract tax under VAT nor attract tax under service tax. That was the position till 2004. Suddenly, in 2004, Supreme Court, in case of K. Raheja, said that a builder, while undertaking construction of a real estate project, he is providing services to the prospective customers. And when he is providing services, construction service to the prospective customers, that means immediately the VAT department jumped into it and said that, but mind you, that was in a different context. That was not in the context of VAT or service tax. That was in the context of Karnataka entry tax. But whatever may be the context, but Supreme Court said that in case of construction by a builder for with an intention to sell, he is undertaking works contract services on behalf of the customers. And when the Supreme Court said so, the VAT department jumped into and said that since there is material involved, so as a builder to a customer, when you are providing works contract service, to the extent of value of materials involved, you are liable to pay VAT. And immediately even service tax department also jumped in and said that yes, there is a service element as well, so you pay service tax on the service element. But mind you, land element still remains untouched. So VAT department said you pay VAT, service tax department said you pay service tax, but that controversy went for the next few years, but finally it was settled that neither VAT nor service tax will be payable. Until and unless in 2012, service tax department came out, or the government came out with the service with some modifications in the service tax law to say that in respect of construction and sale of building by a builder during the case, before or during the case of construction against advance consideration and sale booking, then the builder will be treated as if providing a construction service to the customer. And parallelly, some states, starting from probably Assam, then followed by many other states, they also came out with a mechanism saying that it will be chargeable to VAT on the material portion, and say some states say that you pay 2% on as a composition scheme, you pay 2% on the sale price. Some states say you pay 4% on the sale price or 1% on the sale price. So this way they came out with certain mechanisms to charge and collect VAT on the material element in case of construction service. So now what happens? land still remains untouched, but on the material portion, VAT department started collecting VAT, service tax department started collecting service tax. Finally, in 2017, when GST came in, when GST is rolled out, GST is now imposed again on construction and sale of building by a builder, where again, since there is all the three elements there, land, material, and services, so in GST law, they very specifically say that, okay, you take the value as two-thirds of the sale price. And two-thirds of the sale price means to exclude one-third on account of land, as Shubham rightly pointed out, that it is on account of land. So they said that since land cannot be taxed, so let us presume that one-third of the total sale price is towards land. So let us exclude that. So that is a mechanism which is alternate mechanism which is provided. In the meantime, it would also be apt to mention that in the meantime, Delhi High Court in case of Suresh Kumar Bansal delivered a judgment in respect of service tax, where they had said that service tax on a builder cannot be collected because there is no mechanism in the service tax law, that is Service Tax Act, that is Chapter 5 of the Finance Act, to measure the value of the service portion in real estate. So that was also another aspect. So they said that until and unless the measure is not there, so the levy fails. So therefore, in GST law, it has very abundantly, very cautiously been taken care of and said that, okay, the value will be as may be prescribed as said in section 15. Accordingly, the notification issued in exercise of the power conferred under section 15, and accordingly in that said notification, there is a valuation mechanism specifically said that one-third will be deducted on account of land. So this is the background of taxability of builders, and since these are the three elements involved, this brings all the more complications which will be discussed and deliberated through various issues, and of course there will be some other general issues as well. So I know that Shubham will very brilliantly take care of many of those issues. Some of issues are allocated to me. I definitely deliberate or delve on those issues. Now, friends, these are some of the issues which I am going to cover, and of course I try to stick to the time frame, that is maybe next 20 to 25 minutes. So now, friends, the first point, deduction of land at one-third value. Can it be ad hoc? That is the issue. Now, friends, as I said, as Shubham said, as I also repeated, that one-third is allowed to be deducted on account of land. Now, suppose since I am from Kolkata, in Kolkata, there are some areas where a constructed property is selling at 5,000 rupees per square feet, and there is another area where a constructed property is selling at 30,000 rupees per square feet. So 5,000 and 30,000, so 6 times. Now, what is the differential value attributed to? Construction cost remains more or less same. Suppose, hypothetically again I am saying, but near to real, that suppose in that area of 5,000, the construction cost maybe would be 1,500 rupees per square feet, or let's say in today's scenario, 1,800 rupees per square feet. So in the 30,000 area, the construction cost would go up to, let's say, 2,500 rupees per square feet. So there it is 1,800, here it may be 2,500. But the sale price there is 5,000 and here it is 30,000. And in both the cases, if I deduct one-third, so two-third will be taken as the value of construction. Because what is happening, friends, in case of real estate, in case of builders, how is he earning? He is selling the land as well, because in any real estate project, normally, when they are selling a residential unit or a commercial unit, proportionate right in the land is also transferred. So since proportionate right, that means proportionate title in the land is also transferred. So since proportionate title in the land is also transferred, that means I am selling as a builder, I am selling the land as well as I am providing construction service. So on the land also I am making or earning some profit, and on the construction service activity as well I am earning some profit. Maybe let's say where I am selling at 5,000, if I sell a bare land, maybe I would be selling at 3,000 rupees, say, or 2,000 rupees, or maybe 1,500 or 1,800 as the case may be. And in case of 30,000 rupees area, if I sell a bare land, I would be selling, of course, maybe at say 20 or 25,000 rupees or 28,000 rupees. It will not be similar to that 2,000, 2,500 or 300. It would be very high. That means the price or the value of the land makes the difference in the price mainly. It is attributed to. And marginally the construction cost would also increase. So therefore my profit is more attributable to the land, where the property prices are higher. So in that scenario, considering that in mind, since the law has allowed a one-third deduction uniformly without any such discrimination, this matter is disputed and it went to the Gujarat High Court. Gujarat High Court examined this and they said that no, you cannot do this. You cannot make it compulsory that by compulsorily you have to take only one-third deduction and pay tax on two-third of the sale price. You cannot do this. That cannot be mandatory. It may be prescribed, but it has to be optional. So the builder has the option either to choose deduction of one-third and pay tax on two-third, or they may choose to value the construction service otherwise in an appropriate manner, of course considering the mechanism of valuation as given in section 15 read together with the valuation rules. So Gujarat High Court has very clearly and distinctly laid down this principle, saying that otherwise, if say in case of 30,000 rupees, again if you give one-third deduction, that means 20,000 will be the construction value on which you would be collecting GST, and in the other area on two-third of 5,000, that means let's say 3,300, on that you will be collecting GST. So that means in the 30,000 area, you are indirectly collecting GST on the land, which is not allowed. Because the underline or the bottom line here, friends, is because this will be an issue in many other issues, this will be discussed and this will be relevant. That is why I am just highlighting this. Because here the Gujarat High Court says that indirectly also you cannot charge tax on or GST on the land portion or the land value. That is the bottom line. That is the underlying issue in that which is considered by the Gujarat High Court in case of in this judgment. Now, friends, charges like PLC, EDC, IDC, what is it? PLC means preferred location charge. EDC means extra development charges. IDC means internal development charges. So, external development charges, internal development charges, legal charges, car parking charges, club membership. So, friends, what are all these elements? All these elements are part and parcel of the project itself. When I am going and buying a flat or booking a flat or a commercial unit in a project, that project will definitely have various types of development. It is only a marketing style, I would say, or marketing gimmick, I would say that, or it's a psychology, I would say that the marketing people try to offer the price as low as possible. That means suppose actually they are willing to sell at let's say 10,000 rupees. So initially they would say we are selling at 8,000 rupees. And then they would say, so the project they would be saying that we are selling at 8,000 rupees per square feet, and then yes, 700 rupees on account of IBC, another 700 rupees on account of ADC, 200 rupees on account of club charges, 300 rupees on account of PLC, that is preferred location. If it is garden facing or swimming pool facing, something like that, then it would be another 200 like that. This way, they would ultimately add to 10,000 rupees. But friends, what is the bottom line again? Considering all these together, are they separately sellable or tradable commodities? No, not at all. It is a part and parcel of the project. If I am buying a flat or buying a unit, it will come with all these, whatever developments are there. These are all part and parcel of that, and the conveyance agreement very distinctly, specifically, explicitly would say that this includes proportionate right in the club, proportionate right in all other amenities and facilities. So every common amenities and facilities that will be specifically defined, given in a separate schedule, and specifically it would be said that since as a buyer of this unit, you are getting proportionate right in all these common units, amenities and facilities. So that means all these are being transferred. If all these are really being transferred, so can they now, what is the issue here? The issue here is whether part of a composite supply? Yes, it has to be. It cannot be considered as a separate supply. Composite supply means the definition is what? Composite supply means when one or more supplies are supplied in conjunction, two or more supplies are supplied in conjunction with each other. In conjunction with each other means that has to be a conjunctive supply. That means it cannot be separated. So in this case, these components cannot be separated at all. Yes, I may only have some reservation about the maintenance after completion. So that may be a separate item, yes, but otherwise all these are part and parcel of that same supply. So it has to be a composite supply. Now the problem is we know that after GST, advance ruling somehow, unfortunately, has become very, very popular. Why it is so popular, although it has created, to my understanding, of course, with all due respect to the machinery, but in case of advanced link, the experience has not been well. Various advanced learning authorities in different states, and each advanced learning authority or maybe appellate authority for advanced learning, they have been taking different views which may not really be very well acceptable to the stakeholders, maybe to the taxpayers, maybe to the professionals, maybe even to the courts as well. But fortunately or unfortunately, advanced learning had a very limited objective, but somehow or the other we have run after advanced learning in each and every issue, and for that various advanced rulings are given. There are sometimes they are contradictory by different authorities. Different authorities are taking different views. Sometimes same authority may be say West Bengal advanced ruling authority taking a view reversed by appellate authority for advanced ruling, and all these have created a real confusing situation in GST. So these advanced learning authorities in this particular case, in case of this IDC, EDC, PLC, etc., they have taken a view as if it is not a composite supply. They are saying that when these are separately charged means what? It has to be a composite supply. Even if I am asking the customer that okay, 8,000 rupees I am taking for basic price, 200, 700 rupees for IDC, 700 rupees for IDC, whatever it may say, even if the documents say like that, but still the fact remains that it is a composite supply. But the advanced learning authorities unfortunately have taken a view that no, these will be treated as separate supplies. And if these are treated as separate supplies, then it is very important for us what to take care or what to ensure that the documentation, and when I talk about documentation, starting from sale agreement or even an application for allotment, then the allotment letter, then sale agreement, then conveyance deed, then every demand, etc. Wherever and if, wherever I am mentioning the value or the rate, etc., this should be mentioned as only a single composite rate, not separately. Otherwise, if I am mentioning these items or rates separately, even if we argue these the rulings given by different advancing authorities on this issue, they will come into, they can create difficulties and they will make your life miserable. So it would be invariably it would be going into litigation. So to avoid that litigation, it is always advisable that we take care, we ensure that starting from even promotional materials to application, allotment data, etc., all the documentation related to real estate, the rate should be a composite rate only, a single rate only. That may mention that it includes everything. No separate, nothing being charged separately for any of these items. This can be mentioned like that. Or otherwise, as the general practice goes, to my experience, many builders prefer not to go into any litigation and instead they mention these items separately and they treat them as if they are separate supplies, and accordingly they charge, let's say, whatever 1% or 5% as the case may be on the basic sale price and full rate of 18% on the other charges. That is what in general, as a matter of practice, many builders follow. But it is not necessary to my understanding. So now the point remains is if they charge a consolidated amount single consideration including everything in price, then it equals to a composite supply. If charges are recovered separately for each component, it is not equal to a composite supply. That is the bottom line of the considering the documentation, etc. Terms of sale agreement is considering each and every document. That is the position. Now, third issue, friends, proportionate ITC claim against output of construction service and other charges. Other charges means these are the other charges. PLC, DC, ITC, etc. Now, what is the, if I consider all these as separate supplies, that means basic price as the construction service supply by way of construction service, and the other charges by way of as supplies by way of other services. If that be so, then definitely, and when I am paying 18% on the other charges, that means as if I am making two separate supplies. And if I am making two separate supplies, then in respect of other charges, whatever cost is directly attributable, I would definitely claim input tax credit. It cannot be denied. And yes, there could be some common ITC, that means common, let's say, overheads or establishment cost, etc. So on those again I can claim proportionate ITC. So this would be the scenario considering that if I treat them as separate supplies, which as I said, specifically mentioned, again I would like to repeat that actually it is not a separate supply, it is a composite supply. But if you want to avoid litigation and if you want to follow, it's better to follow those advance rulings, which actually is not at all advisable to follow legally, but still practically to avoid litigation, you may follow advance rulings and in that case to treat them as two separate supplies and accordingly claim ITC which is directly attributed to the other services and proportionate ITC in case of common inward supply. Now, since occupancy certificate, I think it's already mentioned by Shubham as I was hearing, so I would not repeat here. So, state authorities usually issue the completion certificate, but in some cases, in some areas, some specific, let's say, panchayat laws or local laws may not have any provision for issuance of a completion certificate, or even I have an experience that where laws require such certificate to be issued, but still practically it is not being issued for ages, for no reason. So in those cases as well, I can definitely go for certificate by the architect or chartered accountant or engineer, consulting engineer as the case may be. Friends, landowner getting ITC after having already paid in cash in case of area sharing. This is since Shubham has already discussed this model of area sharing and revenue sharing joint development agreement. The basic model he has already shared, he has presented very nicely. So I think that concept is very clear in case of joint development agreement. What is there is on the one hand there is a landowner, on the other hand there is a builder. Landowner has contributed the land, except land, nothing else. He's saying that I don't have resources, money to deploy, I don't have experience to take care of the business, etc. So I will not do anything else. I am simply contributing the land, and wherever any applications, permissions, etc. are required, in any document is required as a landowner, I would sign. That's all. But all other responsibilities will be with you as a builder. So in that case, since the builder will, in case of area sharing means, the builder will share, as he was giving his example, I could see, out of 100 flats to be constructed, 40 flats are allocated to the landowner. If that be so, and he was also talking about the liability to pay tax by the builder on the construction service attributed to these 40 flats which are allocated to landowner. So since the builder will be charging GST on these 40 flats by way of construction service for these 40 flats, so the GST he can charge any time, either before or at the time of completion certificate. That means when the project will be completed, the builder may prefer to raise the tax invoice on completion certificate or maybe before that as well. Now the point here is, in this particular case, if suppose he prefers to raise the tax invoice on completion certificate, that means on completion of the project, but usually any standard joint development agreement has a clause that the landowner, since 40 flats are allocated to landowner and they are specifically earmarked that out of this total 100 flats, which 40 flats are going to the landowner. So landowner is also given a liberty to enter into any sale agreement with any prospective buyer according to his own choice, at his own rate, etc., whatever may be. And the developer will also sign in those sale agreements as a confirming party, and vice versa. In fact, the builder also can enter into any sale agreement with any prospective buyer in respect of his 60 flats, and the landowner will sign as a confirming party. So since the landowner is free to sell before completion, so he will be collecting the consideration say in installments, and as and when he will collect the installments or raise his tax invoice or demand letter as the case may be, he will be liable to pay GST. But on the other hand, ITC of tax charged by the builder or to be charged by the builder, that will come later on. So in that case, what may happen that the landowner has landed up paying taxes every time he is collecting or demanding installments, and at the end of completion certificate, the builder raises his invoice and the landowner can claim input tax credit, but he is not in a position to utilize that input tax credit because he has already discharged his output tax liability. So in that scenario, this issue is talking about. So it is always better to plan in advance that the as and when the landowner will raise a demand on his customers, proportionately let the builder also raise his demand on the landowner because he can issue the tax invoice anytime before issuance of completion certificate as well. So let him raise his invoice so that the landowner every time can claim that input tax credit and utilize it for payment of GST on his portion, sale of his portion. Second thing here is that also we need to mention that suppose in any case if the landowner ends up with any surplus input tax credit at the end of completion certificate because he has already discharged the entire liability, then if at all required, he can carry forward this input tax credit, and if at all he has any subsequent project there, he may utilize this credit. The only thing is, usually in case of joint development agreement, in most of the cases, we might find that the landowners are individuals who do not have resources, who do not have regular business practice of development, etc. So they may not have any future project. But if at all in some cases it is the landowner is also another corporate who are also into real estate business, then they might do so that the unutilized ITC they can use in respect of their future project. Valuation of development rights where commercial apartments remain unsold in revenue. So here, revenue sharing, as Shubham very nicely explained earlier, there could be, it could be any joint development agreement could be normally either on area sharing basis, that is constructed area sharing, or on revenue sharing basis. So in case of revenue sharing, again as he said rightly, landowner provides the land or development right, and the developer is giving proportionate revenue to the landowner. He is sharing or he is remitting proportionate revenue. Let's say again, I take that same example from Shubham. So 40% for landowner and 60% to landowner. So in case of area sharing, he is giving 40 flats to landowner and 60 flats he is retaining, provided of course all these 100 flats are of equal size. If the sizes are different, then of course the number of flats might vary. But I am taking it as if proportionately it is 40% of the total constructed area. So even in case of revenue sharing also, they would have that, okay, 40% of the revenue would be shared with the landowner and 60% with the developer. So in that case, now the consideration is for the landowner is share of revenue received. So for the landowner, he is getting consideration in the form of share of revenue in respect of contribution of the land. So he has given land, that means he has given development right as is understood by the law or as is understood so far. Of course, that itself is a questionable issue that I will talk later on at the bottom of the slide. It is there. But otherwise, since that is considered as the supply of development right, so against that the landowner is receiving share of revenue as a consideration. Now, for valuation, no specific mechanism is provided. Like in other cases, it is there. In this particular case, when it is commercial apartments, no specific valuation mechanism is provided. But still, the fact remains is the value shall be share of revenue, because if development right is considered to be taxable and as a consideration he is getting only the proportionate consideration. So if that proportionate consideration, that value will be the value for development right. But the point here is less 1/3 deduction. Suppose in case of area sharing, probably I have missed that part of Shubham's deliberation. Probably he has covered, I am sure, that in case of area sharing, how the valuation is to be done. That is specifically said that the value of similar apartments, and value of similar apartments means the sale price of similar apartments less 1/3 value, 1/3 of the sale price. So why 1/3 deduction? Because that is on account of land. So that 2/3 of the sale price will be taken as the value of construction. So similarly, here also that means 1/3 deduction on account of land is allowed. So similarly here also, even if it is specifically not provided, 1/3 deduction should definitely be allowed. Although that is questioned by many people, and I know many stakeholders, many departmental authorities, officers, many professionals also have a doubt on this. But I have a very clear mind that even in case of area revenue sharing as well, 1/3 deduction has to be allowed. Because in any case, the land is there, that cannot be denied. So that is why I specifically mentioned earlier in case of Gujarat High Court judgment that indirectly also you cannot charge land. So similarly, on that same analogy here also, since even if my share of or development right, transfer of development right, even if it is considered as supply, but the fact remains that whatever consideration I am getting, that is towards the value of land as well. And if that land value is there, so 1/3 deduction, it has to be allowed. So that is to be allowed. Now, friends, as I said, and unsold or sold units, that will not make any difference. But friends, as I mentioned, the last point, bigger question. What is the bigger question here? The bigger question here is development right at all taxable? Because friends, as again I already indirectly mentioned, that the landowner is giving what? What is that development right that landowner is giving? The landowner very distinctly and explicitly has said that I have land and I am giving the land. And apart from that, I don't have anything else. So even if we call it a development right, he is giving only and only land. Nothing else is going out of his pocket. And if I must mention here, there was a judgment of Supreme Court in 2008 in case of Fakir Chand Gulati. That issue came up before Supreme Court in a different context. That was in the context of a consumer dispute. The landowner said that the developer initially had promised whatever the specifications of the project, and 40% of that as a area sharing, 40 units supposed to come to me, but he has delivered me 40 units, but the specifications are not as promised. So they went to the consumer court, from then state consumer court, then central national consumer court, finally it went to Supreme Court. And the Supreme Court in that case said, and the builder disputed, saying that it is not a case of consumer forum because it is, though no consumer is involved. So it is a joint venture and therefore no consumerism is involved. So the Supreme Court says that no, it is not a joint venture, because in case of joint development agreement, in case of joint venture, actually there should be risk and reward both must be shared. In this case, since risk and reward both are not shared, only it is specifically said that the landowner is giving only land and the construction builder will do everything else and it will be his responsibility, so it is not a joint venture. But whatever it may be, the final outcome, the specific observation from Supreme Court in that case was, friends, the Supreme Court said that the, suppose say in the same example of Subham, land area is, let's say, 100 kattha, for example, hypothetically I am taking, and 100 units of equal size, and 40 units coming to the landowner. That means the Supreme Court said that 60 kattha is being sold by the landowner to the developer and 40 units is being constructed by the developer to the landowner. This is the essence of the transaction. Now friends, if that be so, as I say, since the landowner is not giving anything else apart from land, and that land itself is ultimately being transferred, maybe Telangana High Court, I'll come to that, even Telangana High Court recently has examined this issue and they have said that it is taxable, and even probably that has even confirmed by the Supreme Court as well. But I, with all due respect, I have very reservation on that, because that case, to my understanding, is not properly argued and not completely argued. It is half argued. It is incompletely argued. The issue is because that was completely argued on the basis that the clauses very specifically say that the land is not getting transferred to the builder. Now, friends, the land is not getting transferred to the builder, fine, that is well accepted, agreed. But the land is actually transferred by the landowner. But transferred to whom? To the customers, either to his own customers or to the customers of the builder. So 60 units going allocated to the builder, and builder is selling all those units to their customers with a condition in the agreement itself that when the builder will sell his units to the customer, the land has to be transferred, for which the landowner will sign as a confirming party. So through that agreement, the landowner will transfer his land to the customers. Customers are chosen or brought by the builder only. So that means the landowner is getting construction service to the extent of 40 units against the consideration of those 60 kattha land only. So attributed to 60 units. And for that they are getting consideration. Maybe it is not first transferred to the builder and then to the customer, instead directly transferred to the customer, because initially if it is transferred to the builder, it may be liable to stamp duty, and subsequently if builder again transfers to the customer, it will be liable to again stamp duty. So probably under that respective law, it is permitted that instead of doing that, directly it can be transferred to the customer and only one time stamp duty will be payable. And since it is, I am sure it is allowed, that is why it is being done nationally. Everywhere it is being so done. Otherwise, the authorities are well aware that this daily conveyance is taking place. So therefore, to my understanding, even considering Telangana High Court judgment, I am of the view that the development rights cannot at all be charged to tax at all. That is the bigger question. But even if I don't go into that question, if I accept the taxability of development right as understood or meant by the through those notifications, as mentioned by Shubham or referred to by Shubham, still 1/3 deduction on account of land has to be allowed. These are the. I think I have. Ajay ji, can you confirm? I have some more time. I don't know who is.
Yes, Arun, you can continue.
Oh, Sushil is there. So maybe another.
But you try to conclude within 5 to 7 minutes.
I think I would not take more than 5 minutes. So ITC invoices received after completion certificate for finishing work. Now full or proportionate reversal. Now friends, as we discussed the other services, the basic sale price is considered as one supply, that is supply value of construction, and the other services being considered as a separate supply as other supplies. In that case, what about ITC? Number one, since on the date of issuance of completion, two issues are coming here, friends. On the date of issuance of completion certificate, as per Rule 42, we have to reverse proportionate ITC proportionate to unsold units. Fine, I will reverse. But since the extra charges are considered as a taxable supply, so even after completion certificate also, maybe the basic sale price will not be chargeable to GST, but the additional charges or extra services will still be continue to be chargeable to GST. And if that continues to be chargeable to GST, so that means subsequently I can still continue to claim credit ITC. Number one. Number two, whatever ITC I would claim, even on that as well, proportionate to sold units and unsold units as on rate of city, that also I have to consider. So both these points I need to consider, and accordingly, that means I would continue claiming ITC, but that too only proportionate in the same proportion as sold and unsold as on the date of CC. And to the extent it is attributed to other services, I would claim the ITC. These are the two issues here. A proportionate reversal against deeming fiction of sale of land. Another point which is raised here is, since I am whatever sale price I am getting, out of that 1/3 is attributed to sale of land and 2/3 is attributed to supply value of construction service. So in respect of input services, should I reverse 1/3 proportionate to the land value? That is the question raised here in this particular point. Now friends, to my understanding, no. No reversal is required on account of land, because what happens is the valuation, as I said, the valuation mechanism is given in notification 11, which is issued in exercise of powers under section 15, and in that notification in para 2 probably it is mentioned that for such supply, the total amount charged for such supply, that means they are considering it as one supply there. So as far as this particular valuation mechanism is concerned, they are saying that it is the total amount charged for such supply, and out of that you deduct 1/3 and you consider 2/3 of that as the value of that supply. So that means as if this value is attributed to the entire supply, and land is not a separate supply. So therefore, the entire ITC should be allowed. Number one, no reversal is required because there is no separate exempt supply. That is point number one. Point number two is, anyway, logically also, friends, since their land also I could sell, as I said initially. But instead of that, what I am doing is I am undertaking construction and then I am selling constructed property. So the value of land also going up and my construction service value is also added, obviously. But so far as the construction activity is concerned, all my costs incurred after this bare land, starting from the project, everything is attributed to this construction. Otherwise, had I decided to sell the bare land, then no expenses would have been incurred. So therefore, all these activities are attributed to the logically to the construction activity, and therefore, and on the construction activity, whatever may be the valuation mechanism, based on 2/3, I am paying GST. So no reversal, no proportionate reversal should be required. That is when humble. Now, sale of property on leasehold land. Friends, a very interesting issue that is coming in real estate industry. Maybe I take 2 to 3 minutes here. Some properties are on outright sale, that is freehold properties. Some properties are leasehold properties. And probably this is prevalent in almost all the entire country, in different parts of the country, but at least I am aware about Eastern India, Northern India. It is there that many properties which are given on these long-term lease, say 100 years, 200 years or 300 years. On long-term lease basis, the land is given by the government to various parties for development of various projects, industries, etc. So suppose I have got a land on long-term lease from the government and I am undertaking a project and I am selling it. So in case of long-term lease also, and you will find that in a particular area, one property is freehold, another property is leasehold. But in both the cases, the rate, if the property specifications are more or less same, both the properties, the sale price would also be more or less same. That means in both the cases, the point which I am trying to make is, even in case of leasehold property, I am getting the same price. That means the land value is also included therein. And there are various other justifications for that as well. If you refer to income tax, if you refer to accounting, if you refer to transfer of property act, there are various other aspects, your rights, etc., whatever is transferred, you will mostly find that most of the rights are there. But yes, not 100% rights are transferred, but majority of the rights are transferred, even in case of leasehold property. So since majority of the rights are also transferred, that means as if it is a transfer of title in the land. And therefore, the law says that even if I am undertaking construction of a project on a leasehold land, still I would get one-third deduction. Even if it is freehold, one-third deduction. Even if it is leasehold, one-third deduction. So why one-third deduction? That means in case of leasehold also, the law recognizes that the land value is included. Now, friends, the interesting part is, now they say that post CC, that means suppose in a leasehold property, the construction of the project is completed and I am selling the unit on leasehold basis after CC, then they are saying that you pay or charge GST on the entire consideration. That is the premium, or that is the initial amount which I am charging for giving the unit on leasehold. That's on the entire value. They are saying that you pay at the rate of 18%. Mind you, earlier, pre-CC, I am required to pay at the rate of 1% or 5%, or maybe suppose, let's say it is a commercial unit, so there is no distinction. So in that case, in case of commercial unit, if pre-CC I sell, I would pay 12% on the sale price, because 18% on the value, taxable value, that is 12% on the sale price. But in post-CC, on the same property, I would pay 18% without any deduction. Number one. Number two, in case of PCC, I would pay 12% less ITC of input construction cost, inward supply. And in case of post CC, I will pay 18% without ITC. Why without ITC? Because ITC I will get only when it is used for construction of a building, which is again sold by me during the course of construction only as a builder. Post CC, I will not get any input tax credit. So this is the differentiating mechanism here as is contemplated by the law, and this issue was challenged. In fact, it was challenged that in case of leasehold, the leasehold itself cannot be charged to GST because it is a transfer of title. So it is a transfer of property. In case of Builders Association of Navi Mumbai, BANM, Builders Association of Navi Mumbai, Mumbai High Court examined this issue, and Mumbai High Court said that no, lease is different from construction and sale, and therefore lease will be chargeable to GST. That matter traveled to Supreme Court. Even Supreme Court also upheld that. And not only Mumbai High Court, I think Rajasthan High Court and one or two more High Courts also decided in the similar line. So finally, Supreme Court said that it would be chargeable to GST. So the law remains, there is a discrimination that if it is pre-CC, there is a land element that is recognized, deduction allowed. In case of post-CC, they are saying that it is lease service and no deduction, so full tax. So this itself is absolutely anomalous to my understanding. It cannot be so, but this issue again has not been properly examined, completely examined. And again, I must say that we should examine the judgments of Builders Association of Navi Mumbai even by the Supreme Court. The judgment is not very elaborate and very specific judgment. Various aspects are not considered. But nevertheless, since that is there, we cannot ignore that as well. But this issue remains here. That is my humble submission. Now, last but not the least, from my side on this issue is anti-profiteering methodology. Friends, I will not discuss in detail on this because it is actually one subject where probably this only issue may take maybe an hour to understand the calculations in detail. So I am not going into that. But basically, what is happening, anti-profiteering, the issue we all know that when GST law came in, since earlier the builders were liable to pay service tax at the rate of, let's say, 5%, 4.5% or 5% on the sale price, because only the service element was considered, as I said, the third element. But the second element, that is material portion, was not considered in the value. And VAT was not paid in most of the, like in West Bengal, it was not payable at all. In many other states, it was payable on composition scheme basis, so no ITC was allowed. Now, after coming of GST coming in, since I am now liable to pay GST on service plus material both, so to the extent of material, I am entitled for credit of the material tax paid on materials as well. Credit of taxes in the form of central excise, in the form of VAT paid on the material. So I claim that input tax credit. So that means my cost reduces. If my cost reduces, the anti-profiteering law says that you should reduce the sell price as well. But I said that subsequently, because in any case, being a builder, I am entitled or I am free to raise my sale prices time to time, and which regularly, usually we do. So even after the introduction of GST, I subsequently increased my sale price. But the department is saying that you calculate the ITC attributed to this, and you calculate what is the ratio of total ITC to total sale price post GST and pre GST. And if your total GST ratio or ITC ratio is more in post GST, then the differential at the differential proportion you distribute this amount to the customers. That means as if that is your profit amount, profit element because of GST. Now, friends, this formula is absolutely erroneous. I would say I have very elaborately in detail. I have argued on this in various cases. They are pending in various stages, but this cannot be applied. Now, Delhi High Court recently came out with a judgment in case of probably Rakit Benkaiser. It is Rakit Benkaiser. The name is not mentioned here. In case of Rakit Benkaiser and others probably. So they said that they very nicely examined this issue and explained and observed that the same formula, one size fits all approach. So they have said that one size fits all approach. This approach, this formula cannot be prescribed as each industry is different. So for each industry, the same formula cannot be applied. And the same formula for every project also cannot be applied. There are many reasons, very fine points of arguments on calculations on this. So mechanically, scientifically, it is not a proven method of calculation. So therefore, it has been challenged. The Delhi High Court has observed this. So with this, we need to examine in respect of each, because again, there are many cases in the entire country, I'm sure, on which anti-profiteering issues are and anti-profiteering laws are applied or imposed, invoked, and cases are pending in different stages. So there also, friends, we need to consider this. Thank you very much, friends, for giving me a patient hearing. Yes, at the end, if there is any questions, I would be happy to address as the organizers permit. Otherwise, maybe at the end also we can take it up. Thank you.
Thank you, Arunji, for being here, and please continue with us. We will have question and answer session. We will let the deliberation continue from Subham now. Subham, you have to take some issues.
Yeah, sure.
Please
I'll
continue.
just share my screen once again. Okay. So there are some issues which I would like to take up with regard to JDA agreements. So let me straight away dive into the issues which are present according to me as well. So one issue is that as of now, real estate builders not only have 5% output, they are also having 18% output, right? Like rightly mentioned by Arun sir, in case of supplies which are happening for other charges, the rate of GST is 18%, which is imposed by a few people or few developers. Also, if they're having commercial apartments which are getting sold, so there they are having a rate of 18% and taking 2/3 deduction. So in such cases, there is a dichotomy for availment of ITC, because I can only avail ITC in respect of proportionate output of 12% and 18%. In respect of 5%, I cannot avail any ITC. Now, having said this, one challenge is the computation of availment of ITC and how do I avail only proportionate ITC. There is definitely a formula prescribed under Rule 42 and 43 as to how can I find out the proportionate ITC. I'm not getting into that calculation, but what we need to remember that even though we are having proportionate ITC availment, there is also a restriction provided under law for utilization of the said ITC. Sorry. So in case of when we talk about utilization of the ITC, 5% output it has been provided can only be paid through cash. Now, a lot of builders are availing ITC on proportionate basis. But while filing 3B, they are utilizing ITC whatever is available in their credit balance or in their electronic credit ledger. That means they are not trying to segregate while paying output taxes as to how much output pertains to 5% that I need to pay through cash and 12 and 18% I need to pay only through ITC, that they are not segregating per se. As a result of which, what is happening is they are also utilizing some part of their ITC balance while paying through 12% and 18%. So for instance, my output of 5% is 1 lakh and my output of 18% is 50,000 rupees. Now, if I have a balance of, let's say, 1,10,000 rupees, I am utilizing not only my output of against 18%, but I'm also utilizing my ITC against output of 5%. So as a result of which, what is happening is I'm getting notices from the department. So this notices is actually challenging the fact, can I actually utilize ITC, which is being paid through cash? So though it is a slightly complicated issue, I personally believe we need to look at not just a particular month, whether I have utilized my ITC for making payment of 18%, but the entire project. So I need to ensure in my project as a whole, how much was my output through 5%, how much was my output through 18%, and the ITC which I have availed, have I not, and I need to ensure I have not utilized more than my output of 18% for making payment of output. So I need to make sure that if my output is, let's say, 1 lakh rupees for 5%, 50,000 for 18%, and my ITC is 1,10,000, I need to make sure only for the 50,000 rupees I'm utilizing my ITC, balance I'm paying through cash. If I have done that, if I've utilized more, I need to pay back to the government. If I have, in a particular month, I have done this, in my view, what we can take this as a legal argument is that for the entire project as a whole, for let's say the whole project, how much ITC I have utilized. If the entire ITC I have utilized is less than the amount of my output of 12 and 18%, I find that we are good to go. We can definitely argue the case that my utilization is not incorrect. Having said this, there is also a major issue. If let's say I decide that I need to pay back to the department because I have wrongly utilized the ITC for making payment of 5%, which I should not have done. Mind you, we have already made the payment through ITC. Now, the second time, if we are making the same payment through cash, we are in turn making double payment of taxes. So I need to ensure that whatever output I have discharged earlier through ITC, now I'm discharging through cash. That entire amount I should be getting as recredit. As of now, though there is no specific mechanism prescribed, but PMT03A is a form which allows us to get any amount of excess payment of taxes. So if I have made any excess payment of taxes, that means the earlier payment which I made through credit would be considered as excess payment, given that now I'm paying through cash. I need to make sure that I am getting the recredit of that amount. For that, I need to file a refund application and get it done through PMT03A. Having said this, this is not an established process. This may invite litigation, so we are yet to see how it crystallizes. Next, utilization of remaining ITC of one project in the other project. Arun sir partly covered this issue that if I am, let's say, having one project where I have got any ITC, but I have not been able to utilize that entire ITC in the project. So even after the completion of project, there is some ITC remaining. By ITC remaining, I also mean to say after performing the relevant ITC reversal, proportionate reversal for unsold flats which are remaining and for development rights, whatever is the unsold area, whatever reversals I had to make for that project, assuming I have already done that. In such cases, if I have any balance remaining in ITC, can I utilize it against any other project? In my view, there is absolutely no bar when it comes to utilization of ITC. So any ITC which is in one project can definitely be utilized against the output of some other project if it is remaining after performing the relevant proportionate reversal. Next, taxability of sale of developed plots. I think this is one area which has caused ripples throughout the country, and we have seen multiple advanced rulings coming in with different backgrounds, with different, slightly different case facts as well. And the judgments have also been contrary to each other in a number of ways. So, uh, partially to settle this dispute, the government issued the Circular 177 last year, which says that in case I am actually selling plots, that means in this case, what is happening? I'm not setting a building. There is a IT park which is, let's say, getting constructed, or there is a residential area which is getting constructed, but the builder is not selling apartments. Rather, he's selling plots by dividing the entire land area into smaller plots. As well, there can be some beautification in the green, and there should be some, let's say, gardening, green or greeneries, gardening areas, or there would be some roads which are getting constructed within the premise itself. In those cases, if the builder is actually only selling developed plots by leveling the land, by making sure electricity, drainage lines, all those lines are laid out, thereafter, if he's selling the flat, or rather the plot, if he's selling those plots, whether it invites applicability of GST. Technically, if we consider a definition of project, it includes division of plots and selling it as a plot. So technically, it is considered as a project. Now, if we consider it within the definition of construction, it would be considered as construction of plots. So partially there would be some kind of development which would go into the project. I'm not sure whether we can call it as construction, but there would be some development which would have happened by leveling of land, drainage lines, all those things. To put a rest to this sort of dispute, the government issued a circular that if I'm let's say only laying drainage lines, water lines, leveling of land, only if I'm doing this activity, thereafter selling those plots, it is per se sale of land. So we all know in the beginning itself, we had discussed anything which is sold as land itself. Land is sold as land itself. In that case, it would be considered outside the ambit of supply because it is neither supply of goods nor supply of services as per Schedule 3. So anything which is sold as a plot, if I am doing minimum development activities by means of only leveling and laying of drainage and electricity lines, water lines, those disputes have been resolved by stating that this is nothing but sale of land itself. Having said this, to my mind, the circular somewhere down the line stopped at the major area of dispute, which included that there are some activities which are also outside the ambit of mere development of leveling and drainage lines, which includes, let's say, making of clubs, landscaping, or for that matter, even roads which are getting constructed or any boundaries which are constructed. All of those things have not been clarified in that circular. In my view, definitely, even if it is sale of plots, it would be considered outside the ambit of GST because minimum development activities have been carried out. And if I consider the principal activity and the principal value which gets embedded in it, would definitely be the land itself. So ideally, it should be outside the ambit of GST. Having said this, there can be cases where developments have been quite significant. So it's very important, as RK sir and Sushil sir were also mentioning, that the agreement which we are making has a very important role to play here. So if, let's say, my agreement has a separate bifurcation for sale of land, for basic infrastructure development, for other amenities, definitely for sale of land and for basic infrastructure development, it should be outside the ambit. But for other charges, if the valuation is provided separately, there can be a legal argument which can be taken that GST may be applicable at 18% on those other amenities, other charges, which we would normally also pay in case of a normal real estate project, which is for construction. Having said this, if we are taking only one single value, to state that 12% GST would be applicable after providing 1/3 deduction on the entire construction would be obviously safer for the developer and would be something which may be involving dispute from the department, which would involve less dispute from the department. But the kind of valuation which we would be taking there for as 12% on the entire project may be a little too difficult to justify. So this issue as of now is still unsettled to the extent that development activities have been carried out on those plots. So there can be a different views which can be taken, and based on the structuring of agreement we can take a view whether we should pay 12% as construction services even though the value of land is minimum, value of land is the highest in case of developed plots, or we should pay GST at 18% on other charges, or we should not pay GST at all. So it completely depends on how we are structuring the agreement based on what we discussed now. Next aspect is with regard to payment of damages not provided and quantified at the time of original agreement. So circular 178 was issued that if there is any breach of contract, for example, I entered into a development agreement with the developer as a landowner, and thereafter the developer or defaults on the development activities. Against that, I am claiming damages as for the breach of contract from the developer. Ideally, this cannot be considered as agreeing to tolerate an act if it is already decided that this is merely an event in the contract. If there is a breach in the contract, only in such a situation this damages would be payable. So this is rather agreeing not to tolerate the act. This is what the circular is trying to clarify. And this is merely flow of money. There is no service which is being provided by agreeing to this activity, because this is something which was not agreed, but this was something which was merely a breach in the contract as an event in the contract and not the objective of the contract. The original objective was to carry out the development and not to have this breach in the contract. So in such cases, it would definitely not be applicable. So if it is not provided, the damages are not provided or quantified in the contract, in such a case, the dispute may arise whether this is something which has been agreed after the entire contract has taken place. If this is not pre-agreed, if this was not provided as a clause that there would be some damages paid in case of breach, and this is something which is an afterthought, there can be a challenge that yes, this is an objective of a new contract. In a new contract, it is decided that the original development agreement stands cancelled, for which this amount has to be paid. Having said this issue is still to be settled, and this is not very clearly provided in my view in this circular. So this circular stops to the extent that it is pre-agreed. So it also states that if, let's say, in case of a flat which I'm selling to a buyer, and I'm providing a facility to the buyer that if you, let's say, cancel the booking before the conveyance, 5% would be deducted as your cancellation charges. So here it is not considered as breach of contract, but rather I am giving a facility to the buyer that by merely paying 5%, you can cancel the flat. In such a case, if that happens, we can say that this is not a breach of contract, but rather a facility of the contract. In such cases, for this 5% cancellation charges, GST would be applicable. So this is something that we need to be very careful of and be very clear in the terms of agreement and understand whether liquidated damages is for breach of contract or it is not considered as liquidated damages, it is merely a facility, or it was not pre-agreed. How do we justify it is something which becomes a very important area of planning for any person. Value of similar apartments to be considered for residential, commercial apartments separately or the same in an REP project. So we have seen that in case of a landowner and a developer, we need to actually take value of similar apartments for charging the value of development rights or for the value of construction services to the landowner. In such cases, when we talk about similar apartments, it may happen that in a project, both residential and commercial properties are there. So if you're talking about valuation of first property, do we say that both residential and commercial property combined, whatever is the first property sold, we'll take the valuation of that, or we'll take the valuation of commercial and residential property separately? Let's say in tower 1 of a project, I have got residential apartments, tower 2, I have got commercial apartments. So I need to find out value of similar apartments. Let's say in Tower 1, residential apartments are sold at 5,000 per square feet. In commercial apartment, it is sold as 10,000 per square feet. So if I'm trying to value similar apartments, do I take the value of similar apartments? Let's say the first flat which was sold was commercial apartment. So should I take 10,000 rate for the entire project, which includes first and second tower? It makes little sense according to me. To my mind, value of similar apartments, though it is not defined, we should be taking those values which are more believable. Having said this, this is again an area of dispute. If I take residential and commercial projects valuation separately, it is not provided under law. So this is something which should be coming in as a clarification, because it may significantly impact the valuation between the construction services provided by the developer to the landowner, and vice versa in terms of development rights. Next, ITC accumulation in revenue sharing commercial projects. So as Arun sir was mentioning, in case of revenue sharing commercial projects, we are required to pay, in case of valuation for TDR, the value of monetary consideration. Now the value of that monetary consideration, whether 1/3 deduction is allowable or not, is something which is a dispute. Assuming someone is not taking a deduction of 1/3, so 18% of the entire, let's say 40% I'm paying to the developer. Developer is paying to the landowner. So 100 rupees is the consideration, 40 rupees is transferred to the landowner. So 40 rupees into 18%, 7.2 rupees is the value of development rights. Now, significant value is also there for the materials and the services which go into construction. So if let's say the significant value which goes into construction, it happens that it comes out to 10 rupees, which is quite normal, because there is cement, there is sand, steel, all of this is minimum at a rate of 18%, cement is at a rate of 28. And most of the services availed by builder would be at the rate of 18%. So if I consider the amount paid to the landowner, which is 40%, plus the value of material which goes into that, which is again very high, and I consider 100 rupees is the value which I am charging to my buyer at the rate of 12%, because 1/3 land deduction is around in a way. So my entire costing in terms of my ITC is much higher than my output which I am paying for my commercial apartments which are shown under revenue sharing. So there's a huge amount of ITC accumulation which keeps on happening, which there's a least possibility of getting it refunded. Obviously, it can be taken in any other project, it can be utilized, but there's a huge issue. So a lot of builders are now trying to avoid revenue sharing agreements and trying to enter into area sharing agreements for commercial projects. And the planning of this is required right at the beginning as to what proportion we should be taking for, as to how should we enter into a development agreement under area sharing or revenue sharing, because the computation of what GST would come in based on the budgeting is becoming a very important factor, because there can be significant difference between the output liability which might arise under area sharing versus revenue sharing for commercial projects specifically. Time of supply of development rights under revenue sharing of commercial project. Now, in case of, once again, revenue sharing commercial projects, the question comes in, as and when I am paying consideration to the developer, developer is paying to the landowner, whether the liability would arise as and when the consideration is paid, or would it arise on the first date itself, or when the development agreement is entered. Mind you, in case of all other cases, area sharing commercial, revenue sharing residential, or area sharing residential, all these three other scenarios, it has been provided that development rights liability can be paid at the time of CC. But in case of revenue sharing commercial apartment, that has not been mentioned. So in such a case, we cannot defer the liability till CC. Ideally, in my view, the liability would arise as and when we are making payment to the landowner. There is also a view that the development rights gets transferred on the first day itself. So how can we pay the liability on a phase-wise basis as and when the consideration is paid? Multiple reasons in my view. Number one, the valuation is not available on the first day, because valuation gets crystallized only when the developer is knowing how much to pay to the landowner upon revenue sharing. That is one aspect. Also, the time of supply of services, as per section 13 clearly mentioned that the time of supply would be the date of payment of consideration or 60 days from the date of issue of invoice, whichever is earlier. So in such cases, since the payment of consideration is made at a later date, the date when the development right is actually given to the developer in case of revenue sharing commercial apartment is irrelevant in my view. In my view, as and when the consideration is paid as per time of supply, it should be payable under RCM by the developer for the revenue shared with the landowner. Construction of property for giving on rent. So I'm sure this is something which we are all waiting for. If I'm making my property on own account and it is for giving it on rent to any third party. So idea is if I'm making a shopping mall, a warehouse, or any sort of place or apartment for renting out. In such cases, the Odisha High Court in case of Safari Retreat said that this would not be considered as construction on own account and ITC would be freely available. This matter has already gone to Supreme Court. A number of hearings have already been held. We are yet to see the verdict of the Supreme Court on this particular matter. So as of now, what can be a way out is that we can avail the ITC without utilizing it. So tomorrow, if the judgment comes against us, we can straight away reverse that ITC without any interest and penalty if we have not utilized it. And let's say that judgment comes in favor, we can start utilizing that ITC against our end. If we don't avail the ITC at all, and tomorrow the judgment comes in our favor also, we would not be able to avail the ITC if it becomes time barred. So it is recommended that we should avail the ITC without utilizing it. Next, redevelopment of existing buildings, surrender of tenancy right, tenant rehabilitation. So it may happen that the builder, while entering into a development agreement, also pays to the tenant for the surrender of their tenancy rights or for making sure that tenant is temporarily rehabilitated to a separate place till the project is completed. So in such cases, upon surrender of tenancy rights, there is a clear liability which has been provided through a circular also that if in any outgoing tenant is surrendering his tenancy right, there is a clear liability. And the developer is providing services to the tenant because he is now providing construction services, or a tenant is, let's say, now leaving his property, in turn getting an owned property. So builder is providing construction services, in turn tenant, rather than making payment, is surrendering his tenancy right. So there is again a barter transaction happening where both developer and the tenant are providing services to each other. Of course, the tenant rehabilitation charges would also be included in the valuation for this purpose, because even that is being paid by the developer for the purpose of vacation of the property. So even that would be considered as part of the consideration by the developer to the tenant. In such cases, we have to include it under the valuation also. Next, resale of development rights to a third party for development. So it may happen sometimes the developer A starts the construction of property and enters into a development right. Thereafter, developer A for some reason is not able to carry out the construction or carries out half construction of the property, is not able to complete the project. Thereafter, he transfers his development rights to developer B. So developer A is now transferring the development rights to developer B. Would this be taxable? In my view, absolutely taxable. If we are considering development rights to be taxable in the first hand, even second transfer of development rights is definitely taxable. Question comes in, if I'm actually taxing it, in that case, who will pay the liability? Now, interestingly, if you see the transfer of development rights RCM circular or RCM notification, it says transfer of development rights by any person to a promoter. So the person who is now getting the new promoter who is now getting the development rights is now considered as the person receiving the development rights, and the person transferring the development rights is the old promoter or the old developer. In my view, this would definitely be payable under RCM by the new developer. Time of supply, valuation, in my view, remains the same as which would have been applicable to the old developer. Right? In my view, it would be exactly the same. It would not be differing at all, because it does not say that the valuation and time of supply is only for landowner to developer. It can be for any transfer of development rights. Last, taxability of non-refundable deposits. Now, this is extremely relevant. If I am taking any deposits, whether those deposits are refundable and are to be adjusted against future consideration. If those are refundable deposits and are to be adjusted against future consideration, in such cases, at the time of taking the deposit, it would not be taxable. As and when it is adjusted against future consideration, it would be taxable. But in case of non-refundable deposit, we have to identify the nature of such transaction. Whether the idea of taking this non-refundable deposit was to, let's say, transfer it to an association and not keep it as a charge which the developer would be taking, but giving it to the association. In my view, we can definitely take a stand in those cases that GST should not be taxable in such cases, because those are money which are of the buyers which are lying with the developer only for giving it to the association, which would be money of the association as a capital introduced by the builder, as a capital introduced by the buyer directly to the association. So instead of buyer directly approaching the association, they are approaching it through the builder. In such cases, the amount transferred by buyer to a builder and builder to association, my view, would not be taxable. Having said this, if you are trying to circumvent the law by trying to cover up the transaction by showing any non-refundable deposit, and we are there is a clear quid pro quo that there is a supply which is happening against this non-refundable deposit, and it is not for the purpose of introduction as a capital or for any other reason. In such cases, there can be a stand which can be taken that liability would be arising, because this liability is non-refundable and it is against a clear supply of services. So this is something that we need to very carefully ponder on. With this, I would like to end my session, and I would like to take up the question and answer session along with Arun sir in the Q&A box with the permission of Sushil sir and everyone. Thank you.
Thank you, Shubham, for a elaborated discussion. You can stop sharing the screen. So
Yeah.
you will be visible then.
Yeah.
I think almost all the queries has been answered. Still, number of queries we have received. Most of the participants want to know whether PPT will be available to them or not. It will be made available to them, no issue. I will ask office to share the PPT. Whoever requires, they can use it. Second thing was very pertinent questions. One of the participants is asking, what will be the GST rate on cancellation charges? Suppose one flat has been booked or one property has been booked under construction and it is cancelled, or forfeiture of advance. These two basically items, when some properties are getting cancelled, then developer is either deducting something as a cancellation charges or sometimes they forfeit the advances. So first, Arun Agarwal, what is your views? I think I need views of both the speaker, because here, for the reason that it is very, very burning issue in the industries, and department is taking it differently. Department is not accepting whatever the builders or the landowner is doing. They are disputing it. So how to plan it, your transactions? Let me hear Arun Agarwal.
Yeah, Sushilji, actually, it's a very pertinent issue, very controversial issue as well, eventually observed. But to my understanding, let us understand why it is taxable at all. Because if cancellation charges is to be charged to tax, that means as if it is under that that clause which says that agreeing to tolerate an act or to do an act or a situation and all that. That means it is being treated as an independent supply, as a supply independent of the original supply. So if that is so it will be charged to tax at a applicable rate. And what is the applicable rate? Since there is no specific rate given for this particular service supply, therefore the residual rate, that is 18%, that would be applicable. Crux of the matter.
Sir, I hold the same view. I mean, as of now, for construction services, only the rate is 5%. The moment we are actually withholding the advance which has been paid, it takes a different character completely. So this cannot be called as construction services, because the flat is already cancelled. So whatever residuary rate is applicable as 18% on cancellation charges, that would be theirs.
Nicely, you both of you are submitted that, but I have a different view, and it is basically how to tax the advances. Tax on advances is to be paid at the rate which is applicable on the supply for which the advance has been received. So if the advance has been received for a particular supply, and which we understand is taxable in our case is at the rate of 5%. And if developer and builder or landowner, whoever be the receiving this advance and forfeiting this advance, it is not changing the character. Nowhere in the department has asked for that. In the law, it is mentioned. It is in service tax regime. It was mentioned that even you forfeit it, it will not change the character. Whatever advances you have received for a particular purpose, suppose tomorrow you have received an advance for exempt supply.
Seven, sir, this is what was actually expected. You very rightly pointed out. So, in fact, I wanted that it should be pointed out. So, now coming back to this particular issue, I just would like to say, maybe take 20 to 30 seconds only, that as you mentioned, two words you used. One is cancellation charges, the other one you said forfeiture of advance. So, if we document it as forfeiture of advance, because when I received advance, that is fine. It is, as you rightly said, that it is taxed as an advance and in respect of the supply, and therefore that applicable rate is applied. Now, subsequently, if the agreement only says that if you do not proceed with that, so I will just forfeit the advance. That means the advance will not be refunded. So the rate which I have already applied, that is 5% or 1% as the case may be, that would prevail. Absolutely true. But if I actually document it in a way that there is a cancellation charges which is applicable, so suppose total advance received so far by me from the customer is, let's say, against a total value of 1 crore, I have received 10 lakhs or 20 lakhs or 30 lakhs, and subsequently if he cancels, then I charge a cancellation fee or cancellation charge of, let's say, 3 lakh rupees. In that case, it will be treated separately as we earlier discussed. Anyway, that issue remains. I know I am aware of it. Thank you.
Subham tempted to say something here.
No, absolutely, sir. Same view. So once it is an advance and we are only forfeiting it as an advance, the construction services, the basic character of the service remains the same when we had received that advance. So once it is, there is no payment further made, one can say that it is actually in the nature of advance itself. If we are actually treating it as a cancellation, and there's a separate cancellation which is happening because of the cancellation charges being charged as part of the agreement itself, in such cases, it would be partaking the character of a completely new service. So in my view, in such cases, 18% would be applicable.
Basically, cancellation of a particular transaction is not a separate transactions per se. But anyway, I'm not disputing it, but what the viewer should be getting out of this, and they should note it, while drafting the agreement, you should mention there that whatever be the circumstances under which the cancellation will take place, if cancellation take place, there will be withholding of the advances. This much money will be withheld, or this much money will not be refunded, and considering it as a retention by the builder, and then please do not use the word the cancellation charges. How the department gets triggered when you say it is a cancellation charges, and you book in your profit and loss account as some charges. Once you say some charges, then the HSN will come into play. What will be the HSN of these charges, and one HSN or SSC code for the services. And then you open the book and you will find out the rate of the tax. And then your rate notification you have to visit. So better, whatever you are withholding, you say it will be withheld. It will not be refunded. And no invoices to be issued for this payment. If you end up paying issue the invoices, then definitely you are inviting trouble. And third, it should not be considered as a income from cancellation of the agreement. It should be considered as the income from sale of flats only. Some money has been taken from withhold. This should be withhold money should be have the same color and character. It should not change the color and character. I won't think any problem will come to you, and you can definitely take the benefit of the circular which was government has issued that in the service tax regime, not in the GST regime. It was in earlier regime. Definitely it was issued. Second thing, some few persons want to know what will happen. What happened to GST paid by the customer if he cancel after 2 years? After the initial booking of the amount is paid, can developer adjust against the output tax, or customer has to seek the refund? So basically, they are saying just a cancellation, continuing with the same analogy. Cancellation took place after, say, it is 2 years in this particular query. This gentleman is asking. So whatever money you are refunding, GST is already suffered on that. What will happen to GST? Who will get the refund, or whether the office, this person who is providing the service, who is liable to pay deposit the GST, can he adjust with other liabilities coming in the future? So very relevant queries. And again, I should start in same sequence. Let Arun answer it, then Shubham go ahead on this.
Yes, Sushilji, Chairman sir, again, regarding refund by the buyer. By the buyer, correct, sir. After 2 years, right. So, in fact, the law very specifically says that if there is any cancellation within a specified period, that is probably now it is November of the next financial year. Earlier it was September, so and now the court is saying that for the even for the earlier period also it should be read as November. So, irrespective of that issue, so till next financial year November, if there is cancellation, I can issue a credit note and adjust this liability against my subsequent, this tax against my subsequent liability. But if it is more than beyond that November of the next financial year, then I have to claim refund. Now, who will claim refund? Either the builder can claim refund or the customer can claim refund. If the builder is a registered supplier, obviously he is a registered supplier, so he can claim refund. But there is recently they had issued a circular also to this effect, saying that if the customer wants, the customer can claim a refund. Rather, it specifically says that let the customer claim a refund. And if the customer is a non-registered person, he can claim refund by following that due procedure. There is a specific procedure they have prescribed, so the customer can claim refund. Now, coming back to the third issue, as you specifically said that if the cancellation is beyond 2 years, even in that case also, 2 years probably the querist has mentioned specifically 2 years because he is thinking about probably that refund can be claimed within 2 years from the date of relevant date and which is the date of payment. But in this particular type of transactions, series of judgments from various high courts are there saying that since it is a cancellation of that transaction, so the refund is triggered from that date. So therefore, that should be read as the or treated as the effective date and relevant date, and accordingly from that date, 2 years should be considered. So accordingly, the customer can claim refund even if it is cancelled after 2 years of booking or after 2 years of making payment. After 2 years, if he cancels, still the customer can claim a refund and he will get it following the procedure.
Yes, Shubham. Thank you, Arun.
Sir, same view. So refund can be claimed either by the developer or by the buyer. So if depending on who has borne the incidence of taxes here, if the buyer claims a refund, in such cases, the circular 188 had been issued very recently for refund by unregistered persons. And interestingly, what Arun sir was also mentioning was case laws which have been there for 2 years calculation from which date we need to take it. Even the circular is actually now mentioning that 2 years has to be taken from the date of cancellation and not from the date of original payment. So we will not be going to the residuary category of date of payment of taxes, but the date of cancellation of flat. From that date, we would be calculating 2 years for getting the refund. So if that be the case, sir, there is absolutely no problem when the flat was booked.
So I think viewer has clearly understood this. If you are issuing credit note, you can adjust the tax liability with your future liabilities. It will come in your GSTR, you will adjust the liabilities. And if you are not issuing a credit note, then the buyer can also file a refund claim because he has suffered the tax. So he has all the rights to claim the refund. And Shubham sir has correctly mentioned the circular 188. You please read it if you really suffered by this situation. You please read this circular. It is giving the full guidance and giving all the answers which you are looking for. So thank you all the viewers. First of all, let me thank both the speakers who has dealt the topic in detail.
Thank you.
And although we have last week also last webinar was also on real estate only, and this webinar we have dealt on the joint development agreement. In the coming webinar, where what are the topic we are going to discuss is the reversal under Rule 42 and 43, and this builder has to pay unregistered supplies if he is receiving, how to calculate the tax liability, when to reverse, when to pay this tax liability. So this type of point, leftover topics of the real estate will be taken up in the next webinar. And after that, we will be definitely going to discuss the work content. So it is a weekly webinar. Our viewer can keep the eyes on the website, and the emails are also coming to them. And we wish to fix a particular day in a week. So without seeing the calendar, you can come and join. But it is not yet finalized because good number of committees are organizing program to finding a permanent slot. For every week is little bit difficult for the committee. Anyway, viewers, number of viewers has crossed 2,000. It is almost for the consumption of the both the speaker. I am telling it is 2,206 viewers we have today. Good number, quite and the good question have reached to us, and we have covered almost all the questions. Still, I will ask the committee secretariat to draft the 1 or 2 line answers according to them. These answers should not be considered as a technical advice given by the ICA. It is just a support or guidance is given. Member, whoever using these answers must support their views with the circulars or the notification or rule or sections wherever we. So we will try to give 1 or 2 line answers, and definitely vetted from both the speakers also. So both the speakers are can also viewing your questions, so they will definitely wish to answer each and every queries, which committee will plan and come back to you. So, and so few good number of persons have asked. I think they wanted to go somewhere else, so they wanted to know the this video recording of the same. Let me tell all of you, this is a recorded lecture, and it will be available on the our ICI TV or the ICI channel, wherever you are watching it. At the same platform, this can be viewed later on. But I think it will be uploaded after 2 or 3 days. Some technicalities are required to be completed. Then only it will be uploaded. So earlier videos you can watch anytime. Thank you very much. Both the speaker, the entire team from ICI, I can say Ajay and Dheeraj ji is there. And definitely the technical support we are getting from our technical team. Jay is there. Thank you, participant. Have a happy weekend. And let me, in conclusion, let me once again remind all our viewers: whenever we say there is a program from 5 to 7, it is a program from 5 to 7. It is not 1 minute late in starting and 1 minute late in closing also. So thank you. Although we have started 5 minutes late today and we are closing 5 minutes late today, so this is an exception to our protocols. Thank you.